Hey guys, QIT here. I just survived my second bout of hands, feet, and mouth disease. Yeah, if you've seen a recent video, I had it twice in the span of less than 2 months, but it's over with. Hopefully there's no more different strains at my kids' daycare and I can move on and not get this crazy disease. For those of you who know, you know how bad it is. In this video, we're gonna talk about the dividends I got from XEQT and touch a little bit about dividend stocks versus growth investing, and we're going to get ChatGPT's thoughts in as well, because it's a topic that is brought up a lot in the beginner investor section of the Blossom app. And if you haven't checked it out, it's a really cool community app, social media app, where people are posting specifically finance news or their stock picks or their ETF, different opinions, how to get started. And like I said, one of the common questions is, should I be more dividend? Should I be more growth? Come check out my dividend stocks. What's missing in my portfolio. And so I want to give my thoughts on the topic. So as usual, we're going to take a quick look at the portfolio. Of course, these numbers are going to fluctuate because the market's open right now. And we can see that I'm up about $4,000 from last month. It's trending in the right direction. And for those of you who have requested this from time to time, this is my TFSA, and we can see one day 0%, week 0% change. And last month is still 0%, 2%, 3 months, up 14% in the last year, and all time I am up 15%. So pretty sweet. And now we can look at the dividends that I got last week, I believe last Friday. Now people get excited about this, like $702 from my TFSA, $656 from my RSP. If I go to my QUESTRADE, from all my other accounts, from my FHSA, from my RESP, from my original TFSA in QUESTRADE. We've got all these values in the bottom right, sort of off your screen, but I'll show them on a spreadsheet later. And on Interactive Brokers, it's shown here in the transaction history, $256 and $40, roughly $41 payment in lieu. So what that means is I lend some stocks for Interactive Brokers to use, whether they're giving it to other traders, whatever, and I'm being compensated in an amount, especially when the shares are not given back to me when a dividend is paid. So instead of a dividend payment, they give a payment in lieu as a replacement to that. So when we go to the spreadsheet and add it all up, this gives me $1,745 that I received in dividends last week. And as you know, if you're not a new member or a new watcher of this channel, you would know that I'm not that excited about it, because I know the value of the dividend comes from the total value of the ETF. So whereas a lot of people get hyped about the dividend and dividend day, get excited, they're really happy because they can, I guess, spread it to other stocks that they want, or they just love the feeling of seeing this amount of money. But for me, again, the total value of my stock doesn't change when the dividend is being given to me. And I know a lot of dividend investors are like, why is there so much content against dividend investing? And that's only because, in my honest opinion, there's a lot of misconceptions that beginner investors have. For example, even on the Blossom app, I had a debate or an argument with someone because he thought XEQT was better than VEQT because it gives out dividends quarterly instead of annually. And we all should know, most of us here know, that that doesn't matter. The total return of both of them are going to be comparable regardless of how often they pay out that dividend. So there's just so many things, so many conversations that I've had where there's just enough of those misconception, but it doesn't apply to a lot of you. A lot of you who are into dividends, like Evolveman12, that's always in my comments, that isn't for you. Like, you know what you're doing, that's fine, but I think it's fair to acknowledge that a lot of newcomers do not understand it. They don't get it. And just to illustrate the proof, XEQT does not compound faster because it gives dividends more. We expect both ETFs to run really close to each other. And as you can see on the total return calculator here, look at those lines. They're basically next to each other. Now, there's enough differences between them, their allocation, which causes them to deviate a little. But again, this idea that because it has slightly lower fees, because it gives out dividends more, XEQT is way better or significantly better in some way, that's not true. And this is someone that, you know, I'm invested 100% in XEQT, and I'm telling you, VEQT is just as good. Take it from someone that has over $200,000 invested in XEQT. Now onto the main topic. And as I was saying, there's a lot of these questions that are very similar, income versus growth. So I'm just gonna read a bit of it. I'm new to investing, currently deciding between a growth investing strategy and a monthly income investing strategy. My main question is whether choosing the monthly income strategy means I won't have any yearly growth. If you have experience with either strategy, I'd love to hear why you opt for it. And so like, what's someone do when you got people like PPCE and why dividend growth investing just works? And then you have other guys like that I've met on the Blossom app, Matt, stop investing in dividend stocks. So what's someone to do when there's such strong opinion for both camps? Like in my opinion, you shouldn't attach yourself to a particular strategy, even though it can be fun. Like you've seen like a lot of channels, a lot of Twitter accounts like the dividend guy. But I think that you should just be an investor and view dividend stocks and analyze dividend stocks and growth stocks from a total return perspective. And it'll make more sense as we go through what my opinion is, because as an XEQT guy, what I value more is being diversified by sector and geographically. Whether something is a dividend stock or a growth stock does not matter to me. And again, if you are a stock picker, I think I've said it many times, you should view it as a total return analysis. And let's check out this article that I found June 2017 by Vanguard, Analysis of Dividend-Oriented Equity Strategies. It's a pretty cool article that compares a lot of things that you might be curious about. Dividends, are they like less volatile during the worst periods, which they show here in this graph. So there's equities, high dividend yielding equities, US dividend growth equities, and bonds. And the quick takeaway from here is like bonds are a lot safer when it comes to being less volatile during the worst periods compared to dividend. Like a lot of people think it shelters you, but you can take a quick look at this graph. Not as much as people think it does. The important thing about this video is to talk about like the outperformance. And here it says, going to read this really fast, a belief that these strategies will perform better than broad market equities given their outperformance over our analysis period. What is frequently overlooked, however, is that the performance of these strategies tend to vary over time from one period to the next, and that the majority of the outperformance came from just one period, the technology stock bear market of 1999 to 2000, when both strategies experienced a less significant drawdown than the broad market, as shown in Figure 7. This is important because during the subsequent bear market, the 2008 and 2009 global financial crisis, dividend-oriented equities did not provide the same cushion and underperformed the broader equity markets. So this graph is showing you like if it's above, it's when it's performing better than broad market equities, and when it's below, it's performing worse. And it's saying like outside of this blip here, well, not blip, this huge swing that is just an outlier, it can swing up and down. So growth can sometimes do better, dividend stocks can do better. So when you hear I assume the misconception with the word growth stocks, people think, oh, it's called growth, that means it's gonna grow my portfolio more. Not really. From a total return perspective, that doesn't matter. Heck, I wanted to double check this with ChatGPT to make sure that its database also comes to the same conclusion. As there's no proof on whether dividend or growth stocks perform the best, right? It depends on the specific company. Yes, you are correct. I'm correct. There is no definitive proof that either dividend stocks or growth stocks consistently outperform each other. The performance of stocks, include dividend and growth stocks, depends on various factors such as the specific company, its industry, market conditions, and investor preference. I asked another question. Is there reason to believe one type of stock is less volatile between those two? Generally, dividend stocks tend to be less volatile than growth stocks, is because dividend stocks are often issued by established companies that have a history of generating stable earnings and cash flows. These companies are often in mature industries and have a track record of paying dividends consistently over time. So we saw a bit of that in the stats, that they're probably, in general, they tend to be, according to ChatGPT, less volatile. One last thing I asked is if less volatility doesn't mean higher expected returns, right? You're correct. While dividend stocks generally tend to be less volatile, lower volatility does not necessarily equate to higher expected returns. Like volatility just means like it can swing up really high and it could swing low, but just because dividend stocks have like maybe a smaller range of outcomes doesn't mean they're worse. And if we go back to the conclusion of the Vanguard article, it says, our research indicates that absent beneficial tax treatments, dividend-oriented equity strategies are best viewed from a total return perspective, taking into consideration returns stemming from both income and capital appreciation. Substituting, can't speak, dividend-oriented equities also significantly raises a portfolio's risk profile when used in place of fixed income and diminishes its downside protection. Dividend-oriented equities also tend to have greater interest rate sensitivity, that is, duration, than other equities, making their performance more susceptible to changes in bond yields. The strong historical risk-adjusted performance of dividend-oriented strategies has been time period dependent, with much of their outperformance realized during the technology stock bear market of 1999 to 2000. The performance of dividend-oriented strategies has also been highly dependent on a handful of equity factors. Emphasizing these strategies therefore reflects, in effect, a conviction that these factors will continue to outperform. So what does this all mean, like I said, to the beginning investor? I'm just saying that don't hear these important things like income, monthly income, dividend, growth. I have to be in Tesla, I have to be in Microsoft. That really doesn't matter. To start off, you do want to be broadly diversified, and all-in-one ETFs are the way to go. And a common ETF that people gravitate towards when they are starting out is VDY, when they're interested in creating their portfolio. And the one piece of advice I have for those people would be to understand that the fund only has 56 stocks. So compared to, let's say, the S&P 500 with 500 stocks. So if VDY is like a huge part of your portfolio, then you're exposing yourself to more risk, because it doesn't really have enough companies. It's also all Canadian companies as well. And there is where you can just combine it with other things, which is fine. But again, I hope it all makes sense, that this decision doesn't really matter, and you should focus on the total return of your portfolio. Leave me any questions below. And until next time, I hope I don't get another disease. See you all later.